Hello everyone. My name is Febby Beauty Indah. NPM 244120032. Program Study Accounting. Here, I will explain the material about the definition of an account, and 5 types of accounts, explaining the normal balance for each account, and how to record transactions in the general journal. Stay tuned until the end. A. Definition of account. An account is a record used to document each financial transaction affecting a company's financial condition. Each type of transaction is recorded in a specific account according to the nature of the transaction, and these accounts are classified into different categories based on their type. B. 5 types of accounts and normal balances. 1. Assets. Definition: accounts that record all forms of wealth or resources owned by the company, such as cash, receivables, inventory, and equipment. Normal balance, debit. Explanation: increases in assets are recorded on the debit side, while decreases are recorded on the credit side. In accounting, an account is a record in the general ledger that tracks all financial transactions related to a specific item or category. It provides a systematic way to record and classify financial information, reflecting changes in a business's assets, liabilities, equity, revenue, or expenses. Each account shows the increases and decreases in these categories and is used to create financial statements. For example, cash, accounts receivable, and sales revenue are types of accounts, each representing a different aspect of the company's finances. Accounts H. 2. Liabilities. Definition: accounts that record all obligations or debts the company owes to others, such as accounts payable or bank loans. Normal balance, credit. Explanation: increases in liabilities are recorded on the credit side, while decreases are recorded on the debit side. 3. Equity. Definition: accounts that record the owner's claim or ownership of the company's net assets, such as owner's capital and retained earnings. Normal balance, credit. Explanation: increases in equity are recorded on the credit side, while decreases are recorded on the debit side. 4. Revenue. Definition: accounts that record income or earnings received by the company from its operational activities, such as product sales or service fees. Normal balance, credit. Explanation: increases in revenue are recorded on the credit side, while decreases are recorded on the debit side. 5. Expenses. Definition: accounts that record costs or expenditures incurred by the company to operate its business, such as utilities expense, salary expense, and rent expense. Normal balance, debit. Explanation: increases in expenses are recorded on the debit side, while decreases are recorded on the credit side. C. How to enter transactions into the general journal. 1. Identify the transaction, determine the type of transaction, the accounts involved, and the transaction amount. 2. Determine accounts and normal balances. Identify which accounts to debit and which to credit based on the transaction's impact on the normal balance of each account. 3. Record in the general journal. Enter the transaction in the general journal using the following format. Date of transaction. Name of the account to be debited, along with the amount in the debit column. Name of the account to be credited, with the amount in the credit column, one line below the debit entry, indented. 4. Add explanation or reference. Provide a brief explanation or reference number if needed to clarify the transaction. 5. Review the journal. Ensure the total debits equal the total credits to maintain a balanced journal entry. D. Example of general journal entry. Suppose the company purchases equipment for $10,000 in cash. In this example, the equipment account, an asset, is debited because it increases, and the cash account, an asset, is credited because it decreases. Thank you for watching.